Welcome back to another video. Before we start, please hit the like button down below if you haven't, and please subscribe to help grow our channel. Today, we'll be talking about 5 mistakes that most new investors make. A little backstory, I've been following the stock market since I was 14. I was just so intrigued in how everything worked. I even remember sitting in my grade 9 business class looking at the Amazon stock. In hindsight, I probably should have bought a couple stocks back then. One thing that I did start to realize was that stocks were one asset class that almost all millionaires seem to have. So, from that, I was able to understand that maybe if I want to be wealthy, owning stocks was the secret. Since I've started investing, of course, I've made some mistakes, but I also seen some other new investors make some common mistakes. I wanted to highlight these mistakes so that you don't make these, so that you can avoid them and have larger gains for your portfolio. So let's dive in. The first and most common mistake I see is that most individuals don't start investing sooner. This seems to be the most common mistake across the board when I talk to most individuals. And I find that most people are okay with talking about investing, or they have certain stocks or ETFs that they're really interested in, but they just never pull the trigger and actually purchase them. One thing I have realized is the reason why these people don't pull the trigger and purchase stocks or these ETFs is simply because they have the fear of losing money. These are the individuals that would rather save the money in their savings account or go buy a luxury product. Because in their thinking, buying the luxury product, they actually get to enjoy that money. Or in the stock market, they could just lose it all. Let me tell you, that is far from the truth. Research done by Trayton DeVore found that if you had invested in the S&P 500 over a 15-year period, the chance of you actually losing money is 0.2%, and the chance of you actually making money are 99.8%. Another thing I want to note is investing takes time. So if you think you're going to become a millionaire overnight, that's usually not possible. Yes, we do hear that one individual bought a stock that just completely exploded. Fair enough. But that doesn't happen often. So real investing will take time. Also, I want to know why it's important to start investing sooner. So let's say there's an individual that's 20 years old and they want to have $1 million by the time they're 65. That would mean they would have to invest $208 a month to get to their goal of $1 million at the age of 65. But now let's compare that to someone who started investing at the age of 30 and they had the same goal of having a $1 million portfolio by the age of 65. They would have to invest $467 per month to get to that $1 million mark. That is more than 2 times the amount than the individual that has started investing at the age of 20. At the end of the day, I think I'd be worried about not investing versus investing. Because if you don't invest, there's a very good chance you might not achieve your goal of becoming wealthy. The second mistake I see new investors making is that they invest emotionally. From time to time, we always say that humans are rational beings and they can make decisions between bad and good. But I don't think that's always true, especially when it comes to the stock market. Individuals seem to overreact to market volatility. You'll see it on the news, you'll see it on your TikTok feed, and then you'll see your coworkers just scrambling to either sell their stocks to salvage any money that they can get from the market, and they advise you to do the same. When truthfully, you should be doing the opposite. Warren Buffett has quoted this multiple times. Be fearful when others are greedy, but greedy when others are fearful. The goal is to buy a stock when it's at its lowest and you sell when it's at its highest. Of course, that sounds like common sense, but that doesn't always happen. So that's why it's important when you buy a stock of a corporation that you understand their fundamentals. And if their fundamentals have not changed, you will be fine on the long run. So my little personal advice, I always keep a little cash on the side. So when the market does drop, not only do I invest the amount that I have monthly allocated, but also I can invest a little extra to take advantage of the dip. Also, if you're an individual that you might lose sleep when the market goes down, I might not recommend you investing in individual stocks. I would probably just recommend buying the overall market because that way it shouldn't drop as much as some individual stocks and it will rebound in the long run. If you know you're one of these individuals, definitely take a second and think about it. Third most mistake I see most new investors make is a lack of diversification in their portfolio. I truly believe that we shouldn't just put all our eggs in one basket. I've seen individuals go all in on a stock like Tesla. And yes, if you had bought Tesla 10 years ago, 15 years ago, you would have made a lot of money. But if you're someone who's coming in now, you probably will not be getting the returns that someone did 10, 15 years ago. Spreading money in different corporations across different sectors, such as energy, financial, and technology, is probably the best way to go for most individuals. So for an example, let's compare some sectors. From the chart shown, if you had invested in the technology sector for the past 10 years, you would have made 20.31% average annual return. But if you had only invested in the energy sector, you would see the opposite. The average return from the energy sector is 3.81%, meaning you'd be much below the average market return. So for most, it's worth diversifying your investments. The fourth mistake that I see new investors make, and this one kills me, is trying to time the market. I kid you not, the amount of calls or texts I've gotten at 11 p.m. at night from a friend or a colleague asking me, when do I think the market's going to crash? The truth is, no one really knows the date or the time when the market will crash. Yes, there are gurus out there that advocate that the market's at an all-time high and you should sell because the market will crash. And what happens to those individuals that do follow these gurus? They end up selling and the market hits another all-time high. And now they lost out on other potential gains. So really, no one really knows. Research done by Strategic Wealth Partners compared 4 types of investors. Those being the best timers, who invest during the best time of the year every single year. The worst timers, who invest when the stocks are at their high, right before they drop. The steady Eddie, who invest at the start of each year no matter what the market condition. And the waiters, who don't invest because they think there's always a better time coming. So they took these 4 types of investors and looked at the portfolio from the year 2000 to 2023. And here's what they found. The best timers, who invest at the best time of the year when the stocks are at the lowest, had an average return of 11.1%. And not far behind, they found the steady Eddie had an average return of 10.1%. Even the investors who invested at the worst time of the year each year had an average return of 9.7%. And of course, the waiters, who always wait for the best opportunity, only had a return of 1.5%. So from this data, if you just invest every single year consistently, you'll get a great return without having to worry about timing the market. At the end of the day, when one of the best investors, such as Benjamin Graham, Warren Buffett, Jack Bogle, Peter Lynch, have time and time advised most individuals not to time the market, maybe it's smart to stop timing the market and just invest. The fifth most common mistake I see most new investors make is not having a plan. I see a lot of investors out there that just start investing, which is great, but when they start investing, they actually have no goal of what they want the portfolio to look like when they retire. One of the most common things I see is most individuals start buying high yield dividend stocks to increase their income. But when I sit down and talk to them and I ask them, what do you want your portfolio to look like when you hit the age of 65? And they always say that they want their portfolio at the age of 65 to be greater than $10 million. So in that case, I'd probably focus on capital growth stocks when you're young. And then later on, when you get close to retirement, then I would probably switch it up into buying high dividend yield stocks. At least that's my perspective on how one can achieve their $10 million goal. Also, the other issue that I have with most individuals not having a plan is that they either end up not investing enough or they're just not consistent. So if you're someone who's at the age of 20 and you want to start investing, but you want to have that $10 million portfolio at the age of 65, you need to know how much to invest each month to reach your goal. But if you have no real plan, then you fall into the trap of not investing consistently or just not enough. And investing just goes into the back burner. If you don't have a solid idea of what you want your retirement to look like, that's okay. You don't need to figure out everything today. But I would still advise to make some sort of plan, but then I would tailor your plan every single year so that you can get to your goal, or at least close to your goal, once you have figured out what you want your retirement to look like. I hope you guys can avoid these 5 mistakes that I see new investors making. And if you guys like this video, I might make another video on another 5 common mistakes that I see most individuals make. I hope you guys enjoyed this video. Please stay tuned for future videos. And until then, remember to keep investing.